There are moments in markets when the numbers look completely irrational until you understand what the market is really pricing. Most people look at the present, the market is usually looking at the future. That difference creates confusion, it creates anger, it creates disbelief, it makes ordinary people say, how can stocks be near all-time highs when groceries are still expensive, oil is rising, mortgage rates are high, rate cuts are gone, and consumer sentiment is collapsing? That is the question people are asking now. And it is the right question. Because we may be in the early stage of what people call a melt-up. A melt-up is not a healthy, calm, rational rise in asset prices. It is not the same as a normal bull market built slowly on improving earnings, productivity, and confidence. A melt-up is a late-cycle move where assets rise faster than people expect, often because liquidity, positioning, fear of missing out, and forward-looking optimism overpower the discomfort that ordinary people feel in the real economy. The market climbs the wall of worry. Then it sometimes runs up that wall much faster than expected. And that is when people get hurt in both directions. The people who sell too early because the economy feels bad miss the move. The people who buy too late because the move feels safe may enter near exhaustion. This is why I do not like emotional market decisions. When markets feel terrible, the best prices often appear. When markets feel safe, risk is often highest. That is not because markets are moral. It is because markets are discounting machines, and human emotions lag behind price. Right now, the contradiction is extreme. The stock market has staged one of the strongest short-term rallies in recent memory. The S&P 500 has been moving back toward new highs. The Nasdaq has shown unusual strength. Bitcoin has bounced sharply. Even parts of housing are showing activity. Though the housing picture is uneven and deeply dependent on mortgage rates. At the same time, inflation is not gone. Oil prices have become a problem again. The Federal Reserve has effectively removed near-term rate cuts from the table. Consumers feel worse. Mortgage affordability is still broken. The labor market is fragile. And yet asset prices keep rising. That is the strange part. But strange does not mean impossible. It means you must understand the mechanism. Let us begin with the problem that sits behind everything. Oil. Most people think about oil only when they fill up their car. They see the pump price and feel the pain directly. But oil is much more than gasoline. Oil moves through the entire economic system. It powers cargo ships, trucks, planes, tractors, factories, plastics, packaging, fertilizer, and large parts of the supply chain that bring goods to consumers. When oil rises, the cost of moving almost everything rises. When transportation costs rise, product costs rise. When product costs rise, inflation pressure returns. This is why oil matters so much to the Federal Reserve. The Fed can influence interest rates, it can influence credit, it can influence demand, it can influence financial conditions, but it cannot pump oil out of the ground with a rate decision. If oil rises sharply, it creates cost pressure that monetary policy cannot easily neutralize without damaging demand. The source says that every $10 increase in crude oil can raise inflation and reduce economic growth. Whether the exact sensitivity changes with time, the direction is straightforward. Higher oil raises costs and pressures consumers. Oil had been much lower a few months earlier, but then rose sharply. That changes the inflation picture. If inflation was already around 3.3% before the full impact of higher oil appeared, then the next inflation readings could become more uncomfortable. That is why the market began pushing rate cut expectations further into the future. The logic is simple. Higher oil increases inflation risk. Higher inflation risk makes rate cuts less likely. If rate cuts are less likely, borrowing costs remain higher. If borrowing costs remain higher, mortgages, credit cards, auto loans, business debt, and refinancing costs remain painful. This should be bad for markets, and yet markets have rallied. That is what makes the current period so difficult for people to understand. The Federal Reserve is not cutting, inflation is not fully beaten, oil is rising, consumer sentiment is extremely weak, housing affordability is poor. Still, stocks climb. That is why many people are tempted to say the market is fake, manipulated, irrational, or disconnected from reality. But the better answer is that the stock market and the lived economy are measuring different time frames. Consumer sentiment measures today. The stock market prices tomorrow. The average person feels grocery prices, gas prices, rent, insurance, job uncertainty, credit card interest, and mortgage payments. That is the present. And the present does not feel good for many households. The stock market, on the other hand, is looking ahead 6, 12, or 18 months. It cares about earnings expectations, future liquidity, possible trade resolutions, future policy changes, AI growth, corporate margins, and where capital will move next. Main Street is living through today, Wall Street is betting on tomorrow. This separation can feel unfair because asset owners benefit from rising markets while ordinary households still struggle with prices. But fairness is not the market S function. The market S function is to discount future cash flows, liquidity, and expectations. That is why consumer sentiment can be extremely low while stocks rise strongly. Historically, very low sentiment has sometimes been a good forward-looking signal for investors, because by the time people feel terrible, a lot of bad news is already reflected in prices. If sentiment later improves even modestly, markets can move higher. Pain can create opportunity. This is one of the most uncomfortable truths in investing. The best prices often appear when people least want to buy. The worst prices often appear when people most want to buy. That is why market timing is so difficult. People say they will buy when there is clarity. But clarity is expensive. By the time things look safe, the market may already have moved. By the time the data confirms the recovery, the price may already reflect it. By the time fear disappears, the opportunity may be gone. The source describes a rally that happened so quickly that people who sold at the bottom to wait for clarity missed much of the move. That happens over and over again. The market falls hard. People panic. They sell to protect themselves. They wait for certainty. Then the market rallies before certainty arrives. They miss the rally. Then they buy back later when prices are higher and emotions feel better. This is one of the most common ways investors underperform. They do not underperform because they lack intelligence. They underperform because their emotions are synchronized with the crowd. And the crowd is usually wrong at extremes. When everyone is terrified, prices may already reflect fear. When everyone is euphoric, prices may already reflect perfection. This is why I do not try to be clever with short-term timing. I have seen too many times where the data looks obvious, the conclusion feels rational, and then one policy statement, one oil move, one earnings surprise, one geopolitical event, or one change in positioning reverses everything. The market humbles people who think they have it figured out. This is especially true in a melt-up. A melt-up can continue much longer than rational people expect. It can make cautious investors look foolish. It can make aggressive investors look brilliant. It can create paper wealth quickly. It can draw people in after they swore they would wait. It can move so fast that every dip feels like a missed opportunity. Then eventually, if the move is not supported by real cash flows, earnings, and sustainable liquidity, the bill comes due. That is why melt-ups are dangerous. They can create profits. They can also create complacency. The hard part is that both things can be true at the same time. It may be rational to stay invested. It may also be rational to expect volatility. The solution is not to sell everything. The solution is to own a portfolio you can hold through a 30 to 50% drawdown without being forced into emotional decisions. That is a very different mindset. Most people ask, will the market go up or down next? I prefer to ask, what allocation can I live with if I am wrong? That question is more useful. If you build a portfolio that requires perfect timing, it is fragile. If you build a portfolio that you can keep buying through uncertainty, it is more robust. Now let us look at Bitcoin, because it has become part of the same story. Bitcoin has been recovering while stocks rally. The source notes that Bitcoin rose sharply during a period when the S&P 500 also rose strongly. Institutional money has been flowing back into Bitcoin ETFs. Major financial firms are becoming more involved in crypto products. Large holders and corporate strategies are attracting attention. The national debt continues rising, and investors are searching for alternatives to traditional currency and bond exposure. This is why Bitcoin often becomes more interesting when people worry about debt, money printing, inflation, and currency dilution. But Bitcoin is still volatile. It can fall 30%, 50%, or more. People who claim they will buy on the dip often disappear when the dip arrives. When Bitcoin falls to 60,000, many people say they will wait for 50,000 or 30,000. Then it recovers and they miss the entry. This is the same psychology as stocks. When the asset is falling, people want certainty before buying. When certainty returns, the price is higher. That does not mean you should buy Bitcoin blindly. It is still speculative relative to traditional assets. It should be sized according to risk tolerance. The source describes keeping Bitcoin exposure below 15% of a total portfolio, which reflects the idea that you can be optimistic without going all in. This is important. Conviction does not require concentration beyond your ability to tolerate losses. An asset can have a strong long-term thesis and still be dangerous if the position size is too large. Bitcoin can rise dramatically, but it can also fall dramatically. A position that you can hold through volatility may be intelligent. A position that forces you to panic during drawdowns is not. The right question is not only, do I believe in Bitcoin? The right question is, how much Bitcoin can I own without losing my ability to think clearly? That is true for every volatile asset. A melt-up environment often makes people increase risk because everything appears to be working. But the better time to decide position size is before euphoria, not during it. Now let us turn to housing. Housing is not moving like the stock market. It is much more complicated. National home prices may be up slightly year over year, but forecasts are being revised lower in many markets. Some analysts expect flat national prices over the next year. Others expect modest growth. Some regions may fall while others rise. The country is no longer one housing market. It is many local markets moving differently. This matters because people often talk about housing as if it is one asset class with one direction. That is not how housing works. A home in Las Vegas is not the same as a home in Chicago. A home in Florida is not the same as a home in Connecticut. A home in Texas is not the same as a home in California. Local supply, migration, affordability, insurance, taxes, job growth, climate risk, inventory, and interest rates all matter. The source notes that some Sunday Belt areas that saw major run-ups are now more vulnerable to price declines. That makes sense. The markets that rose the most during cheap money years may face more pressure when affordability breaks and inventory returns. Meanwhile, some northern markets may be more resilient if homes remain relatively affordable and supply is limited. Buyers priced out of expensive coastal or Sunday Belt markets may look for regions where a decent home still costs significantly less. The sticking point is mortgage rates. Mortgage rates are the lock on the housing market. Higher oil contributes to inflation expectations. Higher inflation expectations keep interest rates and mortgage rates elevated. Higher mortgage rates reduce buyer purchasing power. Lower purchasing power reduces demand. Reduced demand pressures sellers, especially in markets with rising inventory, even if mortgage rates fall somewhat over the next several years. The source notes that a decline to around 5.7% by 2030 would increase buyer purchasing power by only a modest amount. That matters because many people are waiting for rates to fall as if that alone will make housing affordable again. It may not. If rates fall from 7% to 5.7%, affordability improves, but it does not reverse the entire price increase of the past several years. It does not necessarily turn a person who cannot afford a house into someone who suddenly can buy easily. Prices, incomes, insurance, taxes, and inventory all matter. This is why buyers are waiting in some markets. They see inventory rising. They see price cuts. They see sellers becoming more negotiable. They know there is no need to rush if another comparable home may appear next month at the same price or lower. That changes bargaining power during the hottest housing market. Sellers had the power, buyers had to rush, waive contingencies, overbid, and accept bad terms in softer markets. That changes buyers can negotiate, sellers must compete, price reductions become more common. Homes sit longer, but again, this is local. The housing market is not crashing everywhere. It is softening in some places, flat in others, still resilient in others. The investor or buyer must study local data, not national headlines. This is the same principle as stocks. The index is not the whole market. The national home price is not your local market. You must understand the specific system you are operating in. Now let us return to the Federal Reserve. The source frames the recent decision as effectively canceling rate cuts for the foreseeable future. Because of inflation concerns, rising prices, consumer spending weakness, and a fragile labor market, that combination is difficult. The Fed wants inflation lower, but it also does not want to break the labor market. If oil keeps inflation elevated, the Fed has less room to cut. This is why rate expectations matter so much. Markets are constantly pricing what they believe the Fed will do next. A few months ago, investors may have expected cuts sooner. Now those expectations move further away. The source says the market is pricing the next cut much later, around October 2027. The exact date can change quickly, but the message is clear. The rate cut story has been pushed out. Normally, fewer rate cuts should pressure assets. But the market has kept rallying. This tells us that the market may be looking past current rate policy toward future earnings, AI growth, liquidity, positioning, and the possibility that conditions eventually force a different policy response. Again, this is why timing is difficult. A rational investor could look at oil, inflation, and no rate cuts and conclude that the market should fall. That conclusion may be logical, but markets are not obligated to follow your logic on your schedule. They can stay overbought. They can become more overbought. They can detach from current sentiment. They can price a future that has not yet arrived. That does not mean valuation no longer matters. It means short-term price movement is often dominated by expectations, liquidity, and positioning rather than the current discomfort felt by consumers. Now, the source also discusses a coming change in Fed leadership, with Jerome Powell scheduled to leave and Kevin Warsh expected to take his place. The exact path of Fed leadership and policy should be treated carefully because appointments, market expectations, and political dynamics can change, but the deeper point is that a new Fed chair can create uncertainty. Historically, new Fed chairs have sometimes been associated with market declines after taking office. The source mentions an average decline around 16% since 1930 following a new Fed chair. Historical averages are interesting, but they are not laws. Each period is different. Inflation, valuation, debt, liquidity, and policy context matter. Still, leadership transition matters because markets dislike uncertainty. If a new Fed chair wants to shrink the balance sheet, reduce money printing, or maintain independence, that could affect liquidity. If political pressure pushes for lower rates, that could affect inflation expectations. If markets believe the Fed will become more dovish, assets may rally. If markets believe the Fed will become more restrictive, assets may fall. Actions will matter more than words. Central bankers often speak in careful language. They defend independence. They talk about data. They emphasize inflation, employment, and long-term stability. But markets eventually respond to what they do, not only what they say. This is why investors should avoid overreacting to every statement. Watch policy, watch liquidity, watch inflation, watch the bond market, watch credit spreads, watch earnings, watch labor. The words are one input. The system is broader. Now let us talk about the central lesson from the whole source. You cannot time the market consistently. This is not because data is useless. Data is very useful. But short-term markets include too many variables: oil, inflation, rates, earnings, geopolitical events, presidential statements, Fed communication, positioning, leverage, sentiment, liquidity, and surprise. You can analyze everything correctly and still be wrong in the short term because one variable changes. That is why the consistent investor often beats the clever investor. The consistent investor decides how much to invest, chooses an allocation that can survive drawdowns, and keeps buying through uncertainty. He does not depend on predicting the next week or next month. He depends on time, discipline, diversification, and the long-term tendency of productive assets to grow. That is not exciting. That is why it works. Exciting strategies often depend on being right repeatedly. Simple strategies depend on surviving long enough for compounding to work. This is why dollar-cost averaging can be powerful. You invest a fixed amount regularly regardless of market conditions. When prices fall, you buy more shares. When prices rise, you buy fewer shares. You remove some of the emotional burden of timing. You stay in the game, of course. Dollar-cost averaging does not eliminate risk. If the market falls, your portfolio falls. If you invest in the wrong assets, consistency will not save you. If your allocation is too aggressive, you may panic anyway. But for broad, diversified, long-term investing, consistency can prevent the biggest behavioral errors. The biggest behavioral errors are selling after declines, waiting for clarity, chasing after rallies, and changing strategy based on headlines. The people who sold in April missed one of the fastest rallies. The people who waited to buy Bitcoin lower missed a sharp rebound. The people who kept investing participated. That does not mean every rebound continues forever. It means the market rewards staying invested more often than it rewards trying to dance in and out perfectly. Now let us think about what a melt-up means for portfolio behavior. If we are in a melt-up, asset prices may rise much more than fundamentals appear to justify. People may feel richer, risk appetite may increase, Bitcoin may rise, growth stocks may rise, home prices may stabilize or rise in certain markets. Speculative assets may attract flows. The broad public may start believing that the worst is over. That can create opportunity. It can also create risk. If you already have a long-term plan, a melt-up can increase your net worth. But you should not let rising prices trick you into increasing leverage or abandoning risk management. Paper gains can vanish. A late cycle rally can reverse. Inflation can return. Rates can stay higher. Earnings can disappoint. A new Fed leadership period can shock markets. Oil can keep pressure on prices. Geopolitical shocks can appear. So the question is not, how do I get as much exposure as possible? The question is, how do I participate without being ruined if the melt-up ends violently? That is a more mature question. A long-term investor may continue buying broad index funds. A person with Bitcoin exposure may maintain a measured allocation instead of going all in. A homebuyer may avoid rushing into a bad deal just because asset prices are rising. A homeowner may avoid assuming the market will bail out every price. A retiree may rebalance if risk exposure becomes too large. A younger investor may keep contributing but avoid speculation beyond a sustainable level. That is how you behave in a market that can rise and still be dangerous. Now let us talk about oil again, because it is the variable that can disrupt the whole melt. Up if oil keeps rising, inflation pressure rises. If inflation rises, the Fed cannot cut. If the Fed cannot cut, financial conditions remain tight. If financial conditions remain tight, consumers struggle. If consumers struggle, earnings may eventually weaken. If earnings weaken, stocks may face pressure. If housing affordability remains broken, housing may soften further. If oil prices feed inflation expectations, long-term yields may rise. That chain can challenge the rally. So why would stocks rise anyway? Because markets may believe companies can still grow earnings, especially large technology companies. They may believe AI productivity and capital spending can offset macro weakness. They may believe inflation will eventually cool. They may believe no rate cuts today mean cuts later. They may believe the Fed will respond if something breaks. They may believe liquidity remains supportive enough. They may believe global capital has few better places to go. Markets can hold several contradictory beliefs at once. That is why price action can confuse people who think in simple cause and effect. Oil up should mean stocks down. No cuts should mean stocks down. Weak sentiment should mean stocks down, but if the market is pricing future growth and eventual liquidity, stocks can still rise. This is why investing requires probabilistic thinking, not mechanical rules. Now let us discuss consumer sentiment. The source says consumer sentiment is at its lowest point in the survey's long history. That is extraordinary. It tells you that ordinary people feel terrible about the present economy. But low sentiment often appears near periods of opportunity because markets tend to bottom before people feel better. The emotional cycle lags the price cycle. People feel worst after pain has already accumulated. They feel best after gains have already occurred. That is why sentiment is a contrarian indicator at extremes. But it is not perfect. Low sentiment can stay low. Markets can fall further. A bad economy can become worse. So sentiment alone should not determine investment decisions. It should be one input. The deeper insight is that your emotions about the economy should not automatically become your investment strategy. You can feel that groceries are too expensive and still keep investing. You can feel that housing is broken and still avoid panic selling. You can feel that politics is unstable and still maintain a diversified portfolio. You can feel that inflation is frustrating and still follow a disciplined plan. Your feelings are information about your experience. They are not always information about future asset prices. That distinction matters. Now let us talk about housing as an investment and lifestyle decision. If you are buying a home now, you cannot rely on national headlines. You must look at local inventory, price cuts, days on market, seller concessions, mortgage rates, insurance costs, taxes, your job stability, and your planned holding period. If you live in a market with rising inventory and softening prices, patience may help. Sellers may negotiate. You may avoid overpaying. There may be no urgency. If you live in a market with limited supply and strong demand, waiting may not create the same benefit. If rates fall modestly, prices may respond differently by region. In markets with limited supply, lower rates can push prices higher. In markets with too much inventory, lower rates may simply stabilize demand. The key is not to buy because you fear missing out and not to avoid buying because national headlines are negative. Buy when the personal and local math works. This is similar to investing. Do not make a large decision based only on macro noise. Make it based on your system. Can you afford the payment comfortably? Do you have reserves? Will you stay long enough to offset transaction costs? Is renting much cheaper? Is the home price reasonable relative to local incomes and rents? What happens if prices fall 10%? What happens if you lose your job? What happens if insurance rises? A good home purchase should survive those questions. If it cannot, you are not buying a home, you are buying stress. Now let us return to Bitcoin and alternative assets. In a world of rising national debt, inflation uncertainty, and monetary policy confusion, people naturally look for assets outside the traditional system. Bitcoin becomes attractive to some because of its scarcity narrative. Gold may also attract capital. Equities may rise as nominal assets. Real estate may retain value in certain markets. The search for hedges becomes more intense, but hedges must be sized. A hedge that is too large can become the main risk. If Bitcoin is 10 or 15% of a portfolio and the investor can handle volatility, that is one thing. If Bitcoin is 80% of net worth and the investor cannot tolerate a 50% decline, That is a very different situation. The same applies to any concentrated asset. A melt-up can make concentration look brilliant. A reversal can make it catastrophic. This is why risk tolerance must be honest. Many people overestimate risk tolerance during rallies and discover the truth during drawdowns. Build the portfolio for the drawdown, not for the rally. Now let us talk about the Fed balance sheet. If a new Fed chair wants to shrink the balance sheet, that means less liquidity support relative to a world of continued expansion. In theory, that can pressure asset prices because the market has become accustomed to central bank liquidity. But the Fed's ability to shrink the balance sheet depends on market conditions. If stress appears, policy can change. This is another reason timing is difficult. A policymaker may intend to reduce liquidity, but markets, banks, employment, treasury funding, and inflation may force adjustments. The stated plan and the eventual reality may differ. Investors should not build portfolios on the assumption that one statement locks in the future. Watch what happens. The market will constantly reprice the probability. Now, what does all of this mean in practice for most people? It means do not abandon a long-term investment plan because the Fed did not cut rates. Do not sell everything because oil is rising. Do not chase everything because stocks are rallying. Do not assume Bitcoin will go straight up because it bounced. Do not assume housing will crash everywhere because certain markets are softening. Do not assume rate cuts will save affordability. Do not assume a new Fed chair will either crash the market or rescue it. The future is uncertain. That is the point. The only strategy that can survive uncertainty is one that does not require perfect prediction. Decide how much you can invest consistently. Choose an allocation you can hold through major declines. Keep enough cash for emergencies so you are not forced to sell. Avoid high-interest debt. Diversify across assets that fit your goals. Rebalance when risk drifts too far. Keep buying quality assets over time. Do not make big emotional changes because of one meeting, one oil move, one rally, or one headline. This is not glamorous, but it is robust, and robust is what matters. Now let us address the psychological trap of all-time highs. Many people are afraid to invest at all. Time highs because the market feels expensive. That fear is understandable. Nobody wants to buy right before a crash. But historically, markets spend a lot of time near highs because productive economies grow. Companies earn profits, and nominal asset prices tend to rise over time with earnings and inflation. An all-time high is not automatically a sell signal. It is also not automatically a buy signal. It is simply a price. The question is your time horizon. If you need the money next year, the market may be too risky. If you are investing for 20 or 30 years, avoiding every all-time high can cause you to miss a large part of compounding. In 2017, when the S&P 500 was at highs, many people worried about a bubble. A long-term investor who continued buying did very well over the following years despite multiple scares, crashes, rate cycles, pandemics, and inflation waves. This is the lesson. The market can look expensive and still become much more expensive. The market can look scary and still be attractive. The market can look safe and still fall. So instead of trying to judge every high or low perfectly, build a systematic process. For most people, that is more valuable. Now let us talk about the allocation you can live with. This is the most important practical idea in the source. Pick an allocation that you can hold through a 30 to 50% drawdown. That means if you own stocks, assume they can fall sharply. If you own Bitcoin, assume it can fall more sharply. If you own real estate, assume prices can stagnate or fall while costs rise. If you own bonds, understand duration and inflation risk. If you hold cash, understand purchasing power risk. The correct allocation is not the one that performs best in a backtest. It is the one you can actually stick with when the world feels terrible. A plan you abandon under stress is not a plan. It is a fantasy. If a 100% stock portfolio makes you panic during a crash, it is too aggressive. If too much cash makes you fall behind inflation and miss long-term growth, it may be too conservative. If Bitcoin volatility controls your emotional state, the position is too large. If housing debt makes you unable to sleep, the mortgage is too big. The portfolio must fit the human. That is where many financial theories fail. They optimize numbers but ignore behavior. Behavior determines whether the strategy survives. Now let us connect this to the melt. Up in a melt-up, a conservative portfolio may underperform for a while. You may watch others make fast gains. That can create envy. Envy makes people abandon their plan. They increase risk late. They buy what has already moved. They tell themselves the world changed. They forget why they had a risk framework. Then if the melt-up reverses, they suffer. This is why you must define your strategy before the mania. If your plan says 80% broad equities, 10% bonds or cash, Like assets 10% alternative assets, then follow the plan. If stocks rise and the allocation drifts, rebalance if appropriate. If Bitcoin doubles and becomes too large, consider trimming. If markets fall, keep buying if the long-term thesis remains intact. The plan is there to protect you from yourself. Now let us talk about the people who are waiting. Some investors are waiting for a crash. They may have been waiting for years. Sometimes waiting works. If you have patience and cash, a crash can create opportunities. But waiting can also become a habit that prevents participation. The market can rise while you wait. Inflation can erode cash, dividends, and earnings compound without you. By the time the crash arrives, the market may still be higher than when you first started waiting. This is why all or nothing decisions are dangerous. You do not have to choose between investing everything today and waiting forever. You can phase in, you can dollar cost average, you can keep a cash reserve, you can invest a base amount monthly and hold extra dry powder. You can create rules for adding during drawdowns. This reduces regret. If the market rises, you participate. If the market falls, you have capital to add. That is more resilient than trying to call the exact top or bottom. Now let us revisit the contradiction between no rate cuts and rising markets. A rate cut is not always bullish, and no rate cut is not always bearish. Markets respond to why rates move. If rates are high because growth is strong and earnings are strong, stocks may handle it. If rates are high because inflation is uncontrollable, stocks may struggle. If rates are cut because the economy is collapsing, stocks may fall even with cuts. If rates are cut because inflation is controlled and growth remains stable, stocks may rise. Context matters. So the statement rate cuts are canceled is not enough by itself. Ask, what is growth doing? What are earnings doing? What is liquidity doing? What is inflation doing? What are credit spreads doing? What is oil doing? What is sentiment doing? What are investors positioned for? The market is a multivariable system. Simple conclusions can be expensive. Now let us talk about the consumer. The consumer is stressed by oil, inflation, and high borrowing costs. Credit card rates remain high. Auto loans remain expensive. Mortgages remain difficult. Insurance costs have risen. Food remains expensive. Sentiment is low. This could eventually matter for earnings if consumers reduce spending. Companies may see slower revenue if lower-income households are strained. Certain sectors may suffer. If oil keeps rising, discretionary spending may weaken, but markets may look past this if they believe corporate profits will remain strong. AI spending will continue, and policy will eventually support growth. This is why the divergence can persist longer than people expect, but it should still be monitored. If weak sentiment turns into weak spending, rising defaults, falling employment, and lower earnings, the market may need to reprice. The point is not to ignore Main Street. The point is to understand that Wall Street may move before Main Street feels improvement, and may also ignore Main Street until corporate earnings are affected. Now let us look at the cycle in simple terms. Inflation rises. The Fed holds rates high. Consumers feel pain. Markets initially worry. Then markets rally because they look ahead to future growth or future policy easing. Asset prices rise. People feel richer if they own assets. Consumer sentiment remains weak because daily costs are high. If the rally continues, FOMO increases. If inflation stays high, the Fed remains constrained. If something breaks, the Fed may eventually be forced to respond. This cycle can produce both melt up and crash risk. That is why the right posture is disciplined participation. Not exit, not reckless chase, disciplined participation. Now let us consider what come out ahead really means. It does not mean predicting every Fed meeting. It does not mean buying the exact bottom in Bitcoin. It does not mean selling the exact top in stocks. It does not mean timing housing perfectly. It means staying financially strong through the cycle. That requires several things: cash reserves for emergencies, a long-term investment plan, no toxic debt, an allocation you can hold, regular contributions, awareness, evaluation, and risk, humility about prediction. Patience. A person with those qualities can survive and benefit from volatility. A person without them can lose money. Even in a bull market, many people lose in bull markets because they chase late, concentrate too much, use leverage, sell during pullbacks, or abandon discipline. The market rising does not guarantee you make money. Behavior matters. Now let us talk about humility. Humility is not weakness in investing, it is protection. The source repeatedly returns to the idea that every time someone thinks they know what will happen, the opposite can occur. That is not just casual observation, it is a deep truth about complex systems. Markets are adaptive. They incorporate expectations. They surprise the majority. They respond to information before it becomes obvious. They can remain irrational longer than you can remain solvent. They can make brilliant analysis look wrong for long periods. Humility says, I do not know the next move, so I will build a plan that survives multiple paths. If inflation worsens, what do I own? If rates stay high, what happens? If rates are cut later, what happens if stocks melt up? Do I participate? If stocks crash, can I keep buying? If Bitcoin falls 50%, do I survive? If housing softens, do I have flexibility? If oil stays high, how does that affect my budget? This is how you think. You do not need certainty, you need preparedness. Now, what about the claim that this could be the last phase of the cycle where everyone feels rich before the bill comes due? That is possible. Late cycle melt. Ups often create a feeling of wealth before the underlying problems are resolved. Asset prices rise. People feel more confident, speculation returns. Then the cost of inflation, debt, high rates, or policy mistakes eventually appears. But the timing is unknowable. The last phase can last longer than expected. That is why selling everything early can be a mistake. But ignoring the possibility of a later bill is also a mistake. A balanced investor participates while keeping risk controls. This is how you avoid both extremes. Now let us think about portfolio construction in this environment. A broad index fund can remain the core for many investors because it gives diversified exposure to corporate earnings and long-term growth. A measured Bitcoin allocation may fit some investors who understand volatility and believe in the long-term thesis. Cash reserves are necessary for stability and opportunity. Bonds may have a role depending on duration, inflation risk, and personal needs. Real estate decisions should be local and math-driven. The percentages depend on the individual age, income stability, debt, risk tolerance, time horizon, family obligations, tax situation, psychology. No single allocation fits everyone. But the universal rule is that the allocation must survive bad news. If your strategy only works when stocks rise, Bitcoin rises, oil falls, inflation cools, the Fed cuts, housing stabilizes, and no recession appears, the strategy is too fragile. A good strategy can handle being wrong about some of those things. Now let us close the loop on inflation. Inflation is the enemy of consumers and the constraint on the Fed. It is also the force that can support nominal asset prices over long periods. This is one of the strange realities of investing. Inflation makes daily life harder, but assets can rise in nominal terms because the currency is worth less and because companies may raise prices. That is why people who hold only cash may feel safe but lose purchasing power. People who own productive assets may experience volatility but have a better chance of preserving real wealth. This does not mean buy any asset at any price. It means staying out of productive assets entirely because the present feels bad can be dangerous. The market often moves before the feeling improves. Now let us talk about the final practical lesson. If you are unsure what to do not make a dramatic move. Dramatic moves usually come from fear or greed. Instead, review your system. How much are you investing each month? Is the amount sustainable? Are you diversified? Do you have high-interest debt? Do you have an emergency fund? Is your stock exposure appropriate? Is your Bitcoin or alternative exposure appropriately sized? Are you over-concentrated? Can you survive a 30 to 50% decline? Are you waiting for perfect clarity? Are you chasing because of FOMO? Answer those questions, then act through rules, not through emotion. The Fed may not cut rates this year. Oil may raise inflation. Stocks may keep rallying. Bitcoin may keep rising or fall again. Housing may soften in some regions and rise in others. A new Fed chair may change expectations. Consumer sentiment may improve or worsen. No one knows the exact path, but you do not need to know the exact path to build wealth over time. You need discipline, you need a plan, you need to keep investing in a way you can sustain. You need to avoid being shaken out by fear or pulled in too aggressively by euphoria. That is how you survive a melt-up. You participate without worshiping it. You respect the possibility of upside and the reality of downside. You accept that markets can look irrational longer than your emotions want them to. And you remember that the goal is not to win the next week. The goal is to build wealth over a lifetime. That is why I stay consistent. Not because I know what the Fed will do, not because I know where oil will be next month, not because I know whether Bitcoin will hit a new high before another crash, not because I know whether housing will rise or fall in every city, but because I know that trying to jump in and out based on headlines is usually a losing game for ordinary investors. The stronger game is to choose an allocation that fits your life, keep contributing, rebalance when needed, manage risk, and let time do what emotion cannot. This market may melt up, it may break, it may do both. The only thing you can control is whether your system is strong enough to handle either outcome. That is where your focus should be.